Hey CPA candidates, it's Matt, co-founder of Universal CPA Review. So before we dive into this simulation on investments in equity securities that's from the Universal platform, please subscribe to our YouTube channel. You can join our Facebook study groups and our study group in the Reddit community. And we also have a free trial that provides full access for 7 days. All of these links are in the description of this video. And remember, if you like the video, please like it. At the very end, subscribe. So let's dive into it. So here we have a simulation on equity securities under the fair value or cost method. Obviously, we know that because it's part of this module. But on the exam, we might not know that. So what do we need to do? Well, we need to read the instructions in detail, which is going to be the first thing we do here. Then we're going to quickly flip through the exhibits. And the point of this is to make sure that we know broadly what information we have, right? Because now with these exhibits, the instructions are pretty brief. So we need to understand what information we have, and then we can go through and attack the simulation. And I know that you're going to nail it. So if you're just watching this video and you're not even attempting the simulation, then that's okay, because every key aspect of the simulation is going to be covered. So here are the instructions. It says on February 6th, year 5, Manti Corp, they purchase 6% of the outstanding common stock of Edison Corp. So common stock, it's a type of equity security. They only own 6%, which really isn't above any significant threshold. And we'll read an email later, but it basically is going to say that significant influence does not exist. So that's how we know that we're using the fair value and not the equity method. Now, additional information obviously is going to be found in the exhibits. The last thing is that the calendar year end for Manti is December 31st, year 5. So what is our role? Well, we're playing the key role as a controller. The CFO is going to share some information. Ultimately, we need to determine what the appropriate journal entries would be for each scenario of this equity transaction, right? We have basically initial purchase date. If there's some dividends, we might have to record any changes in fair value. And then ultimately, Manti, they're going to sell this. So we would need to record the sale of this equity security. So that's actually what's going to be covered in the simulation, but we'll get to that shortly. So as I mentioned, one of the things I love to have candidates do is flip through the exhibits so they know what information they have. You don't need to try to remember or fully understand, but just be aware of what information is provided. So this first one is an email from the Manti CFO. And basically, it just outlines the transaction. We purchased 6,000 shares of Edison Corp's common stock as an investment. Now, they don't have any significant influence, and with 6% ownership, they're going to use the fair value method, right? And any subsequent changes in fair value will be reported through net income. Now, as we should recall, if it's an equity security, right, all unrealized gains and losses as well as realized gains and losses are recorded in net income in the period, right? So if we buy a security, as we did at the beginning of February, well, if we're still holding it at the end of year 5, well, we're going to need to account for any changes in fair value, and those unrealized gains or losses are going to go through the income statement, right? So that should be fairly straightforward. We learned that in the lecture. Now, it also tells us that the purchase price per share was $241 and that they also incurred direct acquisition expenses of $24,000. So we'll figure out what that means later on. Ultimately, like I said, we need to record the initial entry. There's a dividend that's going to come later this year, as well as we need to account for any changes in fair value. And lastly, well, fortunately, the CFO, they seem like a friendly individual. They said, hey, see you at the pizza party on Friday. Who doesn't love a pizza party, right? The next exhibit is for the Edison acquisition expenses. This is for $24,000. It just supports the amount that was in the email from the Manti CFO, right? So this is helpful, but ultimately that information was already provided. The next thing is the Edison dividend information. So they declared it on December 15th, year 5. It was a dividend of $5.25 per share. So when we think about a dividend for an equity security that is being reported using the fair value method, well, we need to remember that we can't assume that it's a liquidating dividend or non-liquidating dividend unless they tell us. So in this case, they don't really tell us, but they do tell us some information about retained earnings. So perhaps part of this dividend is liquidating and the rest of it would be non-liquidating. But that's what we'll get to, and we'll figure that out, and we'll figure out how that impacts the journal entry and the financial statements. This next exhibit, it gives us the stock price per share for common stock at December 31st, year 5. It says that it's $220. Right, that's going to be key because, as we talked about, we need to record the changes in fair value in the year 5 statements, right? Specifically the income statement. It will also impact the balance sheet. So very important to know. Unfortunately for Manti, that is going to be a decrease in the investment, right? Nobody wants to hold a stock and then the value goes down, but maybe it will rebound in year 6. So we'll see. So that's all the information for year 5. They haven't sold it yet, but guess what? In year 6, specifically on April 3rd, year 6, we get an email from the CFO. It says, hey, we're selling all 6,000 shares. And why are we doing that? Well, the stock price is up. We sold at $260 per share. Right, so that's great. We certainly rebounded from last year's fair value, and that's actually above our initial cost of $240. So we'll have to figure out how to record the journal entry in the financial statements and what the ultimate impact to net income and the balance sheet would be. But overall, those are the 5 exhibits that were provided. All of those are important in their own way. So looking at the simulation, right, the first thing we need to do is go ahead and come up with what is the journal entry to record the purchase of Edison on February 6th, year 5. Well, if we go back to the email from the Manti CEO, right, it says we purchased 6,000 shares and our purchase price was $241 per share, but they also incurred $24,000 of direct acquisition expenses. So when we think about, okay, what's the total investment, right? Well, if they purchased 6,000 shares at a price per share of $241, that means the total fair value of the Edison stock was $1,446,000. But we also include those direct acquisition expenses because they're directly incurred with this investment, right? And we would record that as part of our investment on the balance sheet. So that takes it up to a total investment in Edison of $1,470,000. Now the journal entry, it's pretty simple. Is this going to be a debit to investment in Edison for that $1,470,000, and then we're going to credit cash, right? So we're placing the asset on the balance sheet with the debit, and then the credit is a credit to cash for that outflow that we paid, the broker for the stock that was purchased. So that journal entry, fairly straightforward. The next one is a journal entry to record the dividend received during year 5 from Edison. So let's pull up the exhibit with the Edison dividend information. And this actually comes from the CFO at Edison. And they say, hey, Maria, as a shareholder of the common stock, right, you're entitled to the cash dividend we declared on December 15th, year 5. Now it's $5.25 per share. It's going to be paid on Christmas Day, December 25th, year 5. Now they also tell us the retained earning balance. And if we didn't have that, that would be a problem. But fortunately, David, the CFO, he told us that. So how is that helpful in calculating, is it a non-liquidating dividend or is it a liquidating dividend? Because remember, non-liquidating, well, that's recorded as dividend income in the income statement. But if it's a liquidating dividend, that is going to be a reduction of the investment's carrying amount on our balance sheet. So it's super important to know. Otherwise, we're not going to have the right journal entry and our financial statements would be incorrect. So as you can see in the calculation, the first thing we'll do is figure out, okay, what's the cash dividend that Manti actually received? So 6,000 shares times $5.25, that means the cash dividend that they received is $31,500. Now their actual share of the retained earnings, right, and dividends that are considered ordinary or non-liquidating, they're paid out of the current year retained earnings. Anything in excess would be considered a return of capital or a liquidating dividend, right? Well, 6% of the $450,000 retained earnings before the dividend right? That means their share of retained earnings was only $27,000, assuming all of that retained earnings was paid out. So if we subtract the $27,000 from $31,500, well, that means the dividend they received in excess of their share of the current year retained earnings was $4,500, right? So the $27,000 is going to be non-liquidating dividend, which is recorded as dividend income. And then the $4,500, which is the excess amount, is a liquidating dividend, and that's going to reduce the investment on the balance sheet. So when we look at the journal entry, we would plug into the simulation and that Manti we would record into the financial statements. Well, we would debit cash because we received $31,500. Now the credit for dividend income is $27,000. That's going to increase net income in the income statement. And then that $4,500, which is the excess of retained earnings, that would be a credit to investment in Edison, and that will reduce the carrying value of this investment on the balance sheet. So super, super important that we understand how to calculate the difference between what is considered non-liquidating versus liquidating. So those first two journal entries, we knocked them out of the park, and now we're on to our third one. It's December 31st, year 5. Remember, any changes in fair value, well, we record the impact through new net income, right? So remember how we talked about in the exhibit that the fair value of the stock price at December 31st, year 5 was $220. Well, remember we had purchased it for $241. So that means the change in fair value was $21, and it's a decrease. And we hold 6,000 shares. So that results in an unrealized loss on investment of $126,000, right? So not great for Manti, right? They bought this investment and now they've already lost, $126,000. It's an unrealized loss, so it hasn't been realized yet or recognized, but it's not looking good unless the stock recovers. So when we think about, okay, what's the journal entry? Well, we would debit unrealized loss on investment for $126,000. This is going to reduce net income for year 5. And then we're also going to credit the investment in Edison balance sheet account for $126,000, which reduces our carrying value of the investment, right? So overall, that is how we record the transaction now. The unrealized loss is flowed through net income, and on the balance sheet, we have the investment at its fair value. So look at that. We're already on to our last journal entry, which relates to the sale of the Edison investment on April 3rd, year 6. Remember, we got an email regarding the sale of Edison stock, and we see, okay, we sold them all 6,000 shares for $260. So it looks like we're going to have a gain, but to what extent? Well, that's what we're going to calculate. So in step 4, right, we can see the proceeds from the sale investment. Well, sale price per share was $260 multiplied by 6,000 shares. That means they received cash of $1,560,000. Now, when we record this gain, how do we calculate what the amount is? What do we compare it to? Well, we compare it to the carrying value or fair value from the December 31st, year 5 balance sheet. Now, we didn't talk about what that balance was at December 31st, year 5. We only talked about several things that impacted it, right? Remember, the initial cost for the investment was $1,470,000, and that was recorded when we initially purchased it. But then remember, we had that liquidating dividend, and $4,500 reduced that amount. And then we also just had that unrealized loss at the end of December 31st, year 5, right? So we have to also subtract $126,000. So that means as of December 31st, year 5, the carrying value or the fair value on this balance sheet was $1,339,500. So the difference there, that gets plugged to the realized gain on investment of $220,500. So super important to understand that we need to compare it to the latest reporting balance sheet amount and not the initial cost. Otherwise, we're going to double count either the realized gains or losses, right? So we have a realized gain on investment of $220,500. But what's the journal entry? Well, fortunately, the journal entry is not too difficult. We're selling the stock. We received cash proceeds of $1,560,000. We need to remove the asset on our balance sheet, right, from December 31st, year 5, which would have been that $1,339,500. And that's a credit to the investment in Edison account. And then in order for this journal entry to balance, we need to credit realized gain on investment of $220,500. So that means that our net income for year 6 will increase by $220,500. But that's the final journal entry. Now we've recorded all of the impact in our income statement, and the investment is no longer on our balance sheet. So overall, that was a great simulation. We talked through all the different journal entries, right from the initial acquisition or purchase of the stock. We had to factor in liquidating and non-liquidating dividends. We had to do the journal entry to account for any changes in fair value, and then we ultimately sold the stock. So we've covered all the journal entries that they could ask you about when it comes to equity securities that are accounted for under the fair value or cost method. So hopefully you understood that all, but if not, go back, review the video, and you'll be set on this topic.